If you woke up this year and felt like something bigger than headlines was moving the markets, you're not imagining it. The Iran war isn't just a geopolitical story flashing across your phone screen. It's quietly pushing silver prices higher in ways most Americans don't fully see yet. In the next few minutes, I'm going to connect the dots so clearly that you'll never look at a silver chart the same way again. What's happening in 2026 could reshape not only metals, but your purchasing power, your investments, and even the cost of your everyday life. Before we go deeper, if you care about protecting your money and understanding where this market is heading, make sure you're subscribed to Metal Media Insight right now. We break down global events into clear, simple insights focused on the U.S. investor. Our goal is simple: help you stay ahead of the move instead of reacting after it's too late. And as you watch, think about your own portfolio and your own financial future, because this story affects you directly. Let's start with a simple truth. War doesn't just move armies, it moves money. The moment tensions involving Iran escalated into open conflict, global markets reacted instantly. Oil prices spiked, volatility surged. Investors across the United States began shifting capital into assets they believed could hold value during uncertainty. Gold made headlines, but silver started moving quietly and aggressively underneath the surface. At first glance, it may seem like fear buying. Investors get nervous, so they buy precious metals. But this situation is deeper than that. Silver is reacting not only to fear, but to a chain reaction that begins with energy markets and spreads through inflation, industrial demand, supply constraints, and investor psychology. Iran sits near one of the most critical energy corridors in the world, the Strait of Hormuz. A significant portion of global oil shipments moves through that narrow passage every single day. When military conflict threatens that route, energy traders immediately price in risk. Oil futures climb, shipping insurance costs surge, tankers reroute, even rumors can move prices. Now, here's where it connects directly to silver. Higher oil prices increase energy costs worldwide. Mining operations depend heavily on fuel, electricity, and transportation. When oil climbs, the cost of extracting and refining silver rises. Producers in Mexico, Peru, and even US-based operations feel that pressure. As production costs increase, marginal supply tightens. That means fewer new ounces come to market at the same time demand is increasing. But energy is only the first layer. The second layer is inflation. When oil rises, it doesn't just stay in the energy sector. It moves into transportation costs, food prices, manufacturing expenses, and consumer goods. Americans feel it at the gas pump first, then they see it in grocery stores, then in monthly bills. As inflation expectations rise, investors begin looking for protection against declining purchasing power. Historically, gold has been the main hedge against inflation. But in 2026, silver has become the more explosive alternative. It's cheaper per ounce, more accessible to retail investors, and it carries something gold does not: strong industrial demand. That combination makes silver uniquely positioned during a geopolitical shock tied directly to energy. Now let's talk about modern warfare. This isn't just about tanks and troops. Today's conflicts rely heavily on drones, satellite systems, advanced radar, secure communication networks, and precision-guided systems. Silver is one of the most conductive metals in the world. It's critical in electronics and advanced components. When defense production ramps up, silver demand increases quietly behind the scenes. The United States has been increasing defense manufacturing to replenish stockpiles and support allies. While headlines focus on aircraft and missile systems, the raw materials inside those systems rarely get attention. Yet every increase in advanced electronics production adds incremental demand for silver. It may not sound dramatic, but in a tight market, incremental demand matters. At the same time, investors globally grow cautious about holding assets connected to unstable regions. Whenever conflict expands in the Middle East, capital flows toward perceived stability. The United States remains a primary safe zone for global capital. Initially, that can strengthen the US dollar. But here's the twist. As the conflict drags on, government spending increases. Defense budgets expand. Fiscal deficits grow. Markets begin questioning long-term debt sustainability. Over time, concerns about debt and monetary policy can weaken confidence in fiat currencies. That's when precious metals tend to accelerate. Silver often lags gold in the early phase, then moves faster once momentum builds. Imagine you're a middle-class American investor watching your 401k swing wildly. Bond yields fluctuate. Oil prices jump. Analysts debate whether the Federal Reserve can cut rates while inflation risks remain elevated. That uncertainty changes behavior, and behavior drives price. When millions of investors adjust allocations even slightly toward hard assets, the cumulative impact becomes powerful. Another important factor is supply disruption beyond energy costs. Geopolitical instability affects shipping lanes, insurance rates, and trade agreements. Mining investments become riskier in uncertain regions. Exploration budgets shrink when capital becomes cautious. That doesn't reduce supply tomorrow, but it affects expectations 6 months or a year ahead. Markets price expectations. not just current inventory. There's also the technical side. Once silver breaks above key price levels during a war-driven rally, algorithmic trading systems trigger buy signals. Momentum traders enter positions. Retail investors notice headlines and charts on social media. In the United States, retail trading culture is strong and highly connected online. That creates a feedback loop. Rising prices attract attention. Attention attracts buyers. Buyers push prices higher. But this isn't purely speculative. Industrial demand remains structurally strong. Solar panel production continues expanding. Electric vehicles require silver in electrical systems. Grid upgrades across America require conductive materials. When you combine structural green energy demand with defense production and inflation hedging, you get multiple demand channels operating simultaneously. Think about the broader economic backdrop in 2026. U.S. debt levels are significantly higher than in previous decades. Interest payments consume a larger share of federal spending. Global alliances are shifting. Trade relationships are being reassessed. In that environment, tangible assets gain psychological importance. Silver's dual identity as both an industrial metal and a monetary hedge gives it a unique advantage. Some analysts argue that once tensions ease, silver will pull back sharply. Short-term corrections are always possible. Markets never move in a straight line. But history shows that when geopolitical shocks expose deeper structural weaknesses, price effects can linger long after the first ceasefire headlines appear. Investors adjust long-term risk models, not just short-term trades. Now, I want you to think personally. If you're watching your cost of living rise while global instability increases, how does that affect your financial decisions? Do you lean further into equities, hoping for growth? Or do you allocate a portion into hard assets as insurance? Multiply your decision by millions of American households, and you begin to see how collective psychology shapes silver's demand curve. Volatility itself can be bullish for silver. Compared to gold, silver tends to move more dramatically in percentage terms. During crisis cycles, traders often prefer higher beta assets that can deliver stronger upside moves. That attracts short-term capital, which amplifies price swings in both directions. The dollar dynamic also matters. If conflict pressures global growth and pushes central banks toward looser policy to stabilize markets, real interest rates can decline. Historically, lower real yields correlate strongly with rising precious metal prices, especially silver. Investors begin comparing the return on cash versus the protection of tangible assets. Inside the U.S. retail market, physical silver demand has shown signs of strength during heightened geopolitical tension. Coin dealers report increased buying during uncertainty. When physical inventories tighten, premiums rise above spot price. That's often a signal of underlying demand strength beyond paper trading. Exchange-traded funds also play a role. When investors pour money into silver-backed funds, those funds must acquire physical metal to back shares. Large inflows can remove substantial quantities from available supply. In a tight market, that removal contributes to upward pressure on price. Let's connect the chain clearly. Energy shock leads to higher oil. Higher oil fuels inflation expectations. Inflation drives hedging demand. War increases defense manufacturing. Defense production consumes silver. Fiscal expansion pressures currency confidence. Industrial demand remains strong. Supply growth faces constraints. All these forces converge. That convergence is why silver prices are reacting the way they are in 2026. Now I want to hear from you. Do you believe silver is moving mainly because of war headlines? Or do you think deeper structural forces are driving this rally? Drop your thoughts in the comments. Your perspective matters, and it helps this community think critically about what's really happening. If you found this breakdown useful, share this video with someone who keeps asking why silver suddenly feels different this year. Understanding the why behind a move is more powerful than simply watching a chart climb. As we move deeper into 2026, keep watching key indicators. Watch energy markets. Watch defense spending bills in Washington. Watch Federal Reserve language around inflation and rates. Watch physical silver premiums. These signals will tell you whether this move has long-term momentum or if it's simply a spike. Markets don't wait for certainty. They move on probability. Right now, the probability landscape has shifted in silver's favor. The Iran war may dominate headlines for political and humanitarian reasons, but in financial markets, it's rewriting risk models in real time. Silver sits at the crossroads of that shift. The real question isn't just how high silver can go. It's whether you understand the forces behind the move before the next leg unfolds. Stay informed. Stay strategic. Stay disciplined. And here at Metal Media Insight, we'll continue breaking down complex global events into clear insights so you can navigate this changing world with confidence.